Hello everyone and welcome. This is the first time homebuyer webinar, Everything You Need to Know. My name is Ramisa Baig and I'm a licensed realtor and mortgage broker. I have worked with many first-time homebuyers, and if you are anything like most people, you have probably spent hours doing Google research, asking friends and family, watching several YouTube videos, and still wondering, am I missing something important? And if that sounds like you're in the right place. I have created this webinar to save you time and give you everything you need to know and in one place to feel confident in your home buying journey. So let's jump right in. Step 1, your job. What kind of employment do you need to qualify for a mortgage? Yes, it would be amazing if you could buy a home with cash, but let's be real here. While exact figures fluctuate, according to Mortgage Professionals Canada, approximately 67% of homebuyers obtain a mortgage. That means your job and how your income is structured plays a critical role in your approval. And here's what the banks, specifically prime A lenders, are looking for. Permanent employment. Full-time or part-time, job is okay, but it must be permanent. Past probationary period. Your job should no longer be in the probationary stage. Kind of a standard is 3 months, but for some industries, it may be longer, like 6, 9, or 12 months, which is completely okay. But as long as you have passed the 3 months time, you're good to go. The next is the guaranteed income, either a fixed salary or guaranteed hours, and this must be stated on your letter of employment, and the pay stubs must match those numbers. And finally, the letter of employment. This should confirm your role, income, and your length of employment. 2 to 3 years of job history is needed by banks look at your 2 years of work history. It could be possible that you didn't have a job for a few months, which is okay, but as long as you were back on the track, that's what it matters. Now, what if you are self-employed? If you are self-employed, things are a little different. You will need at least 2 years of business tax history. But here's the key point. Revenue is not equal to the income. Let's say your business made $200,000 in gross revenues. And if you write off most of your expenses, the bank doesn't see your income as $200,000. They see what's left over. And that's your net income of the business and how much you have paid yourself in the salary. And that's what they will use to determine your eligibility. Now, a common mistake that I usually see. If you are paying yourself through dividends instead of a T4 salary, it can reduce your qualifying amount. Banks prefer T4 income because it's stable and predictable. Dividends are considered discretionary because they are based on business performance for a given year. 1 year, business may perform much better and give out dividends, but the very next year, it may not. Yes, your accountant might say that if you pay yourself a higher salary, you will owe more taxes. But here's the question you need to ask yourself. Would you rather save on taxes or qualify for a higher mortgage amount and lower interest rate? Because if you don't qualify with an A lender, you may have to go with a B lender where interest rates are typically higher or wait a few years to fix the salary numbers. I'm purposely not covering more details for self-employed mortgage here in this webinar, and we'll cover it in another webinar. Next is, what about multiple jobs or other types of income? Let's answer another common question. What if I have more than one job? Maybe you have one main job during the week and then work another job in the evenings or on the weekends. Most banks only consider your primary job for mortgage qualification, and that's the one they see as most reliable and stable. Can secondary jobs be counted? Sometimes, but it depends. This is usually handled on a case-by-case basis and depends on the consistency of the income and how long have you been working both jobs. Rather than going too deep in exceptions, I would be happy to go over your specific situation. Just reach out to me directly. The next one we have here is, what about other sources of income? Aside from your job, there are a few other types of income that lenders may consider to help you qualify. First is Canada Child Tax Benefit, CCB. If you have children under 12 years old and you're receiving the Canada Child Benefit, some lenders will count that towards your total income. You might ask, why only under 12? That's because most mortgages are on a 5-year term, and lenders want to make sure that the CCB will continue for the full term. Benefits for a child who is over 12 today will be 17 or 18 prior to the end of 5 years term, and that's the reason many banks don't count it. Some buyers say, but what if I'm taking a 3 years term? Good question, but again, it depends on the bank. Most still prefer to use the 12-year-old rule to stay on the safe side. Second is basement rental income. If you are planning to buy a home with a legal or even an illegal non-conforming basement suite, you may also be able to use the potential rental income towards your mortgage qualification. Though you don't own the home or have started collecting basement rent yet, but banks will consider projected rents. Most lenders usually won't count 100% of the rental income, but a very few might. But many will allow 50% or more depending on the bank, location of your home, and the type of the suite. Every bank has their own rules on how do they calculate the basement income, as they can account for expenses like maintenance, repair, heating bills, vacancy rate in your area. The third is the child support or alimony payments. If you receive child support or spousal support, this income may be used to strengthen your application. Just be sure, written in a legal agreement, and you can show that it has been consistent and ongoing. Lastly, pension income. If a parent, grandparent, and older co-signer is helping you qualify and they receive a CPP and Old Age Security OAS, that income can be included as well. And similarly, the same thing, lenders just need proof that it's regular and documentation to confirm the amounts. Next in line is credit score, liabilities, and what not to do before buying. Boy, oh boy, this one is a big one. Let's talk about something that plays a huge role in getting approved for a mortgage, your credit score. Banks want to see a good to excellent credit score, which generally means 660 or higher. If your credit score is below 660, you may still qualify, but likely not through a prime A lender. In that case, you would be looking at an alternate B lender, which often comes with a slightly higher interest rate and stricter conditions like a minimum down payment of 20%. Next is missed payment, bankruptcy, and consumer proposals. Missed payments hurt your score and raise red flags for the banks, so do not skip a payment. And next time, if you had a bankruptcy or consumer proposal, that stays on your record and makes mortgage approval harder with A lenders. So the key takeaway is that your credit report tells a story, and lenders want to know that you manage debt responsibly. Credit card utilization. General rule, keep it under 30%. Even if you pay your credit card balance in full, your credit score can still take a hit if you are using too much of your available credit. For example, if you say, I have a $10,000 limit and I use it sometimes, but I always pay it off in full. That's great, but here's the catch. Your credit report shows your highest usage even if you paid it full in time. So even if you cleared the balance, your report will show that you had used 80% of your available limit. My Equifax approved tip is that try to keep your credit usage under 30% at all the times. This boosts your scores over the time and shows consistent, responsible credit use. Next is liabilities and debt. Now let's talk about the liabilities. This includes car loans, student loan, line of credits, credit cards, or anything you have co-signed on, like your brother was having trouble getting approved for a car loan or a house, and they have used you and your income to get approved. Now, these monthly payments reduce the amount of mortgage you qualify for. How banks calculate your debt load? This may look like a mortgage approval 101 class, and I don't want to make it so complicated. If you can understand it, great, just listen. And if you don't process it, just skip this part. Lenders use two important ratios. First is GDS, which should be less than 39%. It means your monthly mortgage payment, property tax, heating cost, and 50% of condo fees must be under 39% of your gross monthly income. The other ratio is TDS, which should be less than 44%. And this includes everything I have mentioned for GDS, plus all your monthly liabilities like car, student loan, etc. And this must be under 44% of your gross monthly income. Now, if you go beyond 44%, most prime lenders will decline the application. But there are very few banks which will accept your application. But you need to connect with me for that. What if you have student loan? If you know the payment's already great, but if your student loan repayment hasn't started yet, lenders may still factor it in. They typically assume a payment of 1 to 1.5% of the loan balance as monthly payment. So if you owe $30,000 in student loan, they may count $300 to $450 per month as your monthly loan payment. Next is what not to do before buying a home. And here are some common mistakes to avoid if you are planning to buy a home soon. Do not open new credit cards. Close your old credit cards, buy large items like furniture, jewelry on credit, co-sign any loans, take unpaid time off work, and quit your job and start a business. Even if it's your dream, you need to put a pause on that. Why? Because these actions can affect your income stability, your credit score, or your liability calculation, and all of which are critical to getting a mortgage approved, unless you are planning to buy it on cash. Next is understanding the down payment. Let's talk about down payment, which seems to be really easy but gets really tricky and is one of the biggest questions for the first-time home buyers. How much do I need? Let's say if you're buying a property under $500,000, the minimum down payment is 5%. If the property is priced between $500,000 to $1 million, here's how it works. 5% of the first $500,000 and 10% of the remaining amount over $500,000. So for example, let's say you are buying a home for $550,000. 5% of the first $500,000 is $25,000, and 10% of the next $50,000 is $5,000. So the total minimum down payment will be equal to $30,000. So can your down payment be gifted? Yes. A gifted down payment from immediate family members is allowed. However, it must be a true gift, not a loan, and your family member will need to sign a gift letter confirming they don't expect repayment. There is a common question: can I always buy with 5% down? This is where a lot of buyers get confused. Just because minimum allowed is 5% doesn't mean you will automatically qualify with just 5%. And here's why. Earlier we discussed how lenders calculate your debt ratios. If your numbers exceed that 39% and 44% ratios when using 5% down, then unfortunately you won't be approved even if you are within the price range. So what are your options? If your ratios don't work with just 5% down, you have two options. First, increase your down payment until your ratios fall within the required limit. And the second, look for a lower priced home so the mortgage approval ratios are satisfied. So yes, the minimum is 5%, but the actual down payment you need depend on your income, debt, and financial profile. Let's now talk about how to save on taxes, especially if you are a first-time home buyer. Because who doesn't love keeping more money in their pocket, eh? So now I will discuss down payment strategy for tax benefits. Let's say you have $50,000 ready for your down payment. Before you simply use it from your checking account or saving accounts, here's how to make that money work smarter, not harder. Step 1. Use your FHSA First Home Saving Account. If you haven't already, go to your bank and open an FHSA account. Even if your spouse isn't working, they can still open an FHSA account. Transfer your funds from your checking or saving accounts into the FHSA account up to your available contribution room. Why? Because contribution to an FHSA are tax deductible, just like RSP, and withdrawals for your first home purchase are tax-free. No strings, no penalties, just smart saving. Step 2. Use RRSP via the Home Buyers Plan. Once you have maxed out your FHSA contribution, check if you have any contribution room left in your RRSP. Transfer the remaining funds there, and funds must sit there at least 90 days for you to get the advantage of RRSP Home Buyer Plan. Important things to know are that RRSP withdrawals normally come with withholding taxes and are counted towards your income. But if you are withdrawing under the Home Buyer Plan, you can withdraw up to $60,000 tax-free. There's no withholding tax, and the amount won't count as taxable income as long as you are using those funds for your first home. By the way, there's no holding period for funds in your FHSA account. You can withdraw as soon as you're ready to purchase. One pro tip: make sure you check with your bank about how many business days the bank takes to transfer funds back from your TFSA and RSP into your checking or saving account. If the timeline is a little longer, plan to leave some funds in your account for the security deposit in case your offer gets accepted. Step 3 is the GST rebate. If you're a first-time home buyer, you may qualify for a 100% rebate on the GST for newly built homes up to $1 million. It applies only to new constructions. Rebate is fully available on homes priced under $1 million, and it helps reduce your upfront costs significantly. This rebate can make new homes more affordable and is a great incentive if you are buying for the first time. Next is closing cost, the final stretch. Now let's quickly talk about closing costs. These are the expenses you will need on top of your down payment. Lenders want to see that you have at least 1.5% of the purchase price saved for those costs. They don't want to take the money. You just need to make sure that you have that money and you are financially ready. Next is mortgage default insurance, aka CMHC fees. Here's the truth. There are actually 3 mortgage insurers in Canada: CMHC, Sagent, and Canada Guarantee. It completely depends on your bank who they're going to refer your file to. What exactly it is? Mortgage default insurance does not protect you. It protects the lender. If you are putting less than 20% down, the bank considers your loan riskier because you don't have as much equity in the home. So they require you to pay for the insurance that protects them, not you. And here's how it works. If you default, meaning stop making payments, the bank goes to the insurer, example CMHC, and say, this borrower seems to be defaulting on their mortgage. Cover our loss. The insurer pays the bank, and then they deal with you to recover their money. That's a different story and outside today's scope. So how much does it cost? The less you put in terms of down payment, the higher the insurance premium. This fee is added to your mortgage amount, so you don't need to pay it upfront. But if you put 20% down or more, mortgage default insurance is no longer required. That's when your loan becomes a conventional mortgage or uninsured mortgage. However, here's a key difference. Insured mortgage is equal to lower interest rate, and uninsured mortgage is equals to slightly higher interest rate since the bank carries more risk. Pro tip, want to lower insured interest rates even with 20% plus down payment? Ask your mortgage broker or bank representative about an insurable mortgage. You may still qualify for lower rates if the mortgage meets certain criteria. But insurable and insured mortgages are capped at a 25 years amortization, while conventional uninsured mortgages can go up to 30 years, helping reduce monthly payments. Your mortgage professional can help you choose the best product that fits your situation. Next, we will be talking about understanding the 3 types of insurance in home ownership. After working with many home buyers, first time or experienced, I have noticed a common confusion around insurance and mortgage-related insurances specifically. So let's break them down clearly because each serves a completely different purpose. First one is mortgage default insurance. We just discussed that is there to protect the bank in case the homeowner defaults on their mortgage. Second is mortgage, life, and disability insurance. Mortgage insurance is offered to you when you are finalizing your mortgage application, either through the bank or a mortgage broker. It covers your mortgage payments or pays out a lump sum amount in case of a death, critical illness, or disability of a homeowner. In mortgage insurance, usually the bank is the beneficiary, meaning the payout goes directly to them to pay off your mortgage, and related fees like discharge fees, penalties, legal costs. Whereas in life insurance, the payout goes to your beneficiary that you must have assigned, and then they can choose how to use the money after a loss. While this coverage is optional, it's often recommended to protect your family from losing the home if something happens to you. And lastly, we have home insurance or property insurance. This is required by lenders and protects the physical home. It covers damages like fire, flood, storm, vandalism, or theft. You must have heard about this type of insurance, especially in areas like Calgary in the recent years, where hail and extreme weather have caused significant damages to the properties. And here's a cherry on top, tenants insurance. If you are going to keep tenants in the basement of your new home, ask them to purchase their own tenants insurance. This insurance will protect them and their belongings in the case that the rental unit has fire, flooding, or vandalism. Remember, homeowners insurance does not take care of tenants and their belongings in the case of a fire or a theft. So this wraps up our first part of the webinar, where I covered behind the scene information before you even start the action. And before we start part 2 of this webinar, I want to answer a really common question, which is, if we hire you as our realtor, how much do we pay you? The answer is, if you are a buyer, you don't pay me anything out of your pocket. I get paid by the sellers. And if I'm helping you with your mortgage, I get paid by the bank. Now that you have done the homework and understand the basics, it's time to take the action. So let's get started with the action part of the webinar. Step 1, get pre-approved. We have mentioned this before, but it's worth repeating. Pre-approval is the foundation of your home buying journey. It gives you a clear picture of how much you can borrow, what interest rates do you qualify for, and what your estimated monthly mortgage payment is going to be. But here's where it gets crucial. An important reality check that the pre-approval is not equal to affordability. Just because a lender approves you for a certain amount doesn't always mean you should borrow that much. And let's not forget, life happens. So budget wisely. Ask yourself that if only one person in the household is working, can we still comfortably make the payments? And if the answer is no, it might be the time to adjust your expectations or your finances. If two people are working, there's more room to manage risk. If only one income is carrying the household load, it's smart to stay below your maximum approved amount. And most important of all, your first home doesn't need to be your dream home. And that's okay. You might not check every box this time, but you're getting your foot in the door. You're building the equity. You're starting the journey. It's not about just buying a home. It's about living in it peacefully. Step 2, start house hunting. Work closely with your realtor. Focus only on homes within your price. Prioritize your must-have versus nice-to-haves. And lastly, stay flexible. No home is perfect, especially the first one. If you can get all the boxes checked, great. If not, you can look into adjusting your expectations. Remember, the goal is to find a home that fits your lifestyle and your budget. Step 3, watch the market and book showings. For the resale properties, once you have set your criteria, you will start receiving daily email alerts within your market search with the new listings, price drops, any homes that are back on the market. From there, we will schedule showings for any home that might interest you so you don't miss out on the right one. But if our discussion turns out to be that you will be buying a brand new built home, I will be working with you to find the best deal on the market within your budget. Step 4, making the offers and handling counter offers. Found the house that you like? Great, now we prepare the offer. We will work together to decide the offer price, possession date, the terms and conditions that you would likely be putting in that offer, or any other term the seller might accept, reject, or send a counter offer, and we will negotiate to get the best deal. And if it doesn't work out, we move on and keep looking. Step 5, condition period to firm sale. So let's assume your offer was accepted. Congratulations. Now we enter what's called the condition period, which is the time you have to satisfy certain terms and conditions listed in the purchase contract before the sale becomes firm. Now this is a very important step, especially for the first-time home buyers. And honestly, anyone buying a property, a lot of buyers, especially in highly competitive sellers market, sometimes choose to write an unconditional offer, meaning no financing on property inspection condition. This is completely the buyer's choice, but as someone who has worked with many clients, I highly recommend including conditions, especially the home inspection condition. You see, not all problems are visible at first glance. Everything might look just perfect, but there can be hidden issues you won't know about until someone trained actually goes and inspect the property. There's a popular belief that if the house is brand new or hasn't been lived in before, you don't need a home inspection. Many think the new home warranty will cover everything or assume it's new. What could go wrong? Let me share a real story with you. With one of my clients, they fell in a property which was nearly a new home, just 2 months old. No one had ever lived there and was still under new home warranty. Even the other agent asked me, why are you even adding a home inspection condition on this one? But I insisted, get the inspection. And what happened? The inspector found out a significant issue with the furnace setup, something the owner never realized because no one had ever lived there. The system was running inefficiently, and the sellers were unknowingly paying very high utility bills. Because we had that inspection, my clients were able to flag it before moving in, and it was addressed under the new home warranty. Had we skipped that step, they would have moved in and discovered the problem later, likely after the expired warranty or without any documentation. And here's another tip for anyone already living in a new home. If your 1-year warranty is coming to an end, get a property inspection done before it expires. It's a small cost for peace of mind. Even if nothing major is found, you will know for sure. And if there is something wrong, you will still have time to get it covered. So what happens during the condition period? This is the time to secure final mortgage approval if financing is a condition. Complete the home inspection, get the appraisal done for the property, and this is something that banks usually require to understand if the worth of the property is similar to what you are paying for. Clarify any legal or title issues. You will work really closely with your realtor, mortgage broker, or the bank, lawyer, home inspector to make sure everything is in order. If everything looks good, we will waive the condition, and that's when the sale becomes firm. However, if something doesn't go as planned, maybe your financing fell through or you found some serious problems during the inspection, you can always walk away from the deal without penalties, as long as you had that property inspection condition. In the past, especially in hard sellers markets, buyer would sometimes skip the conditions to stand out in the bidding war. For example, offering a lower price but with no conditions, hoping the seller accepts it over a higher price but something with a condition. But as of now, when I'm recording this in May 2025, it's a balanced to buyer's market, which means you have the room to include conditions, and you should. Pro advice: if you are a first-time buyer, you have likely saved for years to get into this first home. Most people use up a big chunk of their saving just for the down payment and closing cost. So moving in only to find out surprise bills is not an ideal start. And that's why I always say, put in the conditions. They are there to protect you. Step 6, the final closing, and it's almost yours. Now we are at the last and most exciting part of your home buying journey, the closing day. Once your conditions have been waived and the deal has become firm, it might feel like things start to move really fast, and they usually do. Depending on an agreement between the buyer and the seller, possession dates may vary. Some buyers may move in as early as 15 days, while others might close in 30, 45, or even 60, 90 days. It all depends on what has been negotiated. During this period, there's a lot of happening behind the scenes to ensure a smooth transition into your new home. What should you be doing during this time? Start packing. Yes, it's real. Time to get those boxes out and sort through the things and plan your move. Schedule your movers. Book early, especially if you're moving on a weekend or month end, because that's when the moving companies are in a high demand. Set up utilities, water, electricity, gas, internet to be transferred or started at your new address on the possession day. Update your address with Canada Post, your workplace, your bank, some behind the scenes to your financial finalization. While you're busy packing your stuff, your mortgage broker or the bank will be finalizing all the financing details. At this stage, your lawyer will receive all the necessary paperwork from the seller's lawyer. Your mortgage funds will be sent to your lawyer's trust account before closing, and you will receive a call from your lawyer's office to schedule an appointment a few days before the possession. Make sure to ask questions. Your lawyer is there to help you understand everything you needed for this transaction. And lastly, the possession day. On the actual possession day, once the lawyer completes the final exchange of funds and titles, your lawyer will confirm the transfer of ownership. Your realtor or the builder gets the go-ahead to release the keys to you. This is the moment you have been working towards. You walk into your very first home as a homeowner. Whether you bought a condo, townhouse, or a single-family home, it's a huge achievement and a proud milestone. Take it in, celebrate. It's just a beginning of a new chapter. And that brings me to the official end of this webinar. If you would like a PDF copy of these slides, feel free to reach out and I will be happy to share it with you. Are you ready to buy your first home? If yes, let's connect and get started on finding your dream home. If not quite ready yet, that's totally okay. You can follow me on Facebook, Instagram, and all other platforms so we stay connected. Reach out whenever you are ready. After working with many home buyers, I can confidently say preparation is everything. Knowing what's realistic, what's affordable, and what works for your lifestyle is the key. Remember, your first home doesn't have to be your dream home. It's your foundation into real estate ownership. I'm Ramisa Beg, your realtor and mortgage broker, and I would be honored to be a part of your home ownership journey. Let's connect. I would love to help you every step of the way. Talk to you soon and have a wonderful day.